Hello again and welcome back for another edition of London Direct. The latest Chinese inflation data has really given the commodity exporting countries something to think about once again ahead of the Reserve Bank of New Zealand meeting. I've been speaking to Ranko Berich from Monex. Before we start talking about New Zealand, there's been a lot of Chinese data out, particularly in terms of inflation. I've read different interpretations of what it means. What's your take on it?
Well, first of all, the headline CPI, the headline inflation index, did actually perform quite well. Some people are saying that was partly due to Chinese New Year, a bit of gift giving, a bit of a shopping spree. The truth is we won't know until a few more months of data come out. But also producer prices continue to plummet, which is really what monetary policymakers, well, in addition to the consumer price index, will be looking at.
Yeah, so what about the PPI number was particularly interesting, which includes the factory wholesale numbers. That was down by 4.8%, continues to decline. Is that anything we should worry about, or is that just down to commodity prices?
I think partly, yes, it is due to commodity prices, partly it's due to softer global demand for Chinese exports, and I wouldn't say it's anything to worry about, but it is probably one of the reasons that recently forecasts for the Chinese economy have been turned down.
Let's move on to New Zealand, the RBNZ's meeting. It seems the main focus for the RBNZ will be the housing prices in New Zealand. Is that fair?
Yes, that's right. So the Reserve Bank of New Zealand is, they've been doing inflation targeting for a very long time. They're a very cutting-edge central bank, and they generally tend to be ahead of the curve. So that's why we saw them raise interest rates early last year. And so I don't think we'll see any kind of a knee-jerk reaction from the RBNZ, but increasingly there is a realization that property prices in New Zealand are increasingly unsustainable. And so they put out a call earlier this month, essentially for ways that they could use macro-prudential measures to control house prices without necessarily manipulating interest rates. So the question is, how confident are they in the macro-prudential measures that they're able to come up with, and will they be forced to resort to rate hikes?
Yeah, we talk about all sorts in Forex, and we have to talk about milk when it comes to New Zealand. Fonterra, again, has been put on alert by these maybe fake claims that the milk supply is going to be poisoned. Is that a real worry for New Zealand and the Kiwi dollar?
Absolutely. I mean, fear is a very real thing in financial markets, and essentially what's happened is there's been rumours, or I think maybe an environmental group that actually went as far as threatening to poison some milk exports, which is extraordinarily damaging as a fear. Now, ANZ Bank has gone and said that the damage to the New Zealand dollar won't be permanent. However, I think that the downwards trend on Kiwi, especially against US dollar, is still quite persuasive. So perhaps Kiwi will struggle to regain some of the ground that it's lost.
Yes. So what is your outlook for the New Zealand dollar in the next 3 months or so? Because it does have that relatively attractive carry.
That's right. So the carry trade is still quite strong, but the reality is, I think we're in a very different environment to last year. Carry trades are typically what you see when there's quite low FX volatility. So considering we're not really in a low volatility environment in FX anymore, I think you have to be just that extra little bit braver to take those carry trades without sort of wondering where the currency is actually going to go.
Well, thank you to Ranko. As you can probably tell by his accent, he's really got some great insight into New Zealand. Stay tuned to Copy TV for more analysis and interviews. But for now, goodbye.